All right, folks, part 2, chapter 10. So now we're going to take a look. Here is that revenue procedure 8756. So notice what they do is they list a number of different assets. And what basically you have to do is to look to see where the asset falls in which one of these items. And again, this is only part of it. And then here's the general recovery period. So this is what normally is used. Okay. Now you also have, it's called ADS, so the alternative recovery period. This is for a company that wants to extend the life and take less depreciation. Basically, it's because they think it matches better. But typically, this is the column used right here. Okay? So if you're wondering in the problems, generally this is the column they're looking for you to take right here. Okay? And by the way, here's most common business assets. Okay? 5 years for trucks, computers, and peripheral equipment, office furniture, stuff like that, 7 years. So basically, you take the item or that group of items and you find which one it fits into. Okay? All right, now in tax, they have what are called depreciation conventions. The typical convention, the general rule, is a half a year. You take 1/2 of full year's depreciation in the first year and the last year of an asset's life. Okay? So basically half and half. First year half, last year half. Okay? And again, those tables automatically account for it. So when you're looking at those tables and those percentages, that's already calculated in. And if it's disposed before it's fully depreciated, only 1/2 of the depreciation is allowed in the the disposition. So wherever you're at, whatever year it is, you only take half. Okay, so that's the typical convention. Okay. Now the mid-quarter convention. Now this one, like it says here, relatively irrelevant post Tax Cut and Job Act. It's when 40% of the qualified business inventory is placed in the last quarter of business. So what they're getting at here is they don't want to give you half a year's depreciation when you've put in a large amount in the last quarter of the year. They go, wait a minute, you get more depreciation than you really should because you put it in the last quarter. And there are separate tables and rates for this. Okay, and we'll still calculate it as part of the class. So when you take a look, you have to determine first, should it be half year or mid-quarter? Locate the proper table, select the column, and then find the row. Okay, apply half year convention, half year for the disposition, applying mid-quarter convention, and mid-quarter. So let's take a look. Here is the half year convention. So notice the first year is 33 and a 3-year. So basically, if you take a look below, see how the second year is greater than the first year? That's because you're only taking half. Remember, this is essentially double declining balance here, okay? But you're only taking half. So if you take a look here on the 5-year, right? 5-year, normally if you did straight line, it'd be 20%, right? Double would be 40%, but because you only get half, you get 20%, okay? Again, so these are the different, based upon the different years. And predominantly you're using these first 3 years right here. Not always, but predominantly. Okay? And then they show you year 11 all the way down through 21, depending upon what type of item, you're looking at. Okay? All right, so here's the mid-quarter. I don't think you could, let me see if I can make it bigger. You can see it too well. So the mid-quarter, okay, so for mid-quarter, normally, if it's a 5-year item, you're going to wind up getting 35% in the first year. Mid-quarter for property placed during, so this is during the first quarter, this is during the second quarter, this is the third quarter, and then the fourth quarter. So if you take a look at the difference in the fourth quarter. Here you get 5%, and in the first quarter you get 35%. And in the second quarter you get 25%, third quarter 15%. So what they did, they broke it down, basically giving you less depending upon what time of the year you put it in service. Okay? Now, for mid-quarter, when it takes the full year depreciation, so the quarter of the disposition, if it's in the first quarter, you take 12.5%. And how you calculate it is 1.5, that's mid-quarter, divided by 12. The second, it's 4.5 divided by 12, again, midway through the quarter. So second quarter, that's months 4, 5, and 6. So mid-quarter would be 4.5, right? Halfway through. All right, so here, let's take a look at an example, okay? Make this a little smaller here, a little bigger. Okay, so let's see. Now, it says 2021, it's a little bit old, but the same numbers apply. It says they put in a die cut machine, it cost $3,500, and they did it in the first quarter. Then, they got a computer, cost $1,200, and they put it in the fourth quarter. So the first thing is, what is the recovery period? Well, you look up on that chart, and you see the computer is 5 years, and the machine is 7 years. Now, the question is, okay, what convention should they use? So you got to take a look and say, well, how much, when did they put it in? So the question is, they got a total of $4,700 in assets. So you add this one. So basically, you add these two together. You're adding these two together to get $4,700. Then you take the $1,200 divided by the $4,700, and you wind up getting 25.53%. That's less than 40, so that means you use the half year. Okay, you use half year for these. All right. Now it says assume all the same facts, but notice what they did. They flip-flopped the items. Now we bought the computer first, and then we cut the die cut machine back in the fourth quarter. Okay? So now we have to use mid-quarter. Why? You take 3,500 divided by 4,700, you're at 74%. So now you have to look at those separate charts. Okay? So you go back and you're like, okay, the computer was 5 years, and it's that you wind up with 35%. If you go back, let's go back to those charts. Let's see, make it a little bigger. Okay, so 5 year, the first quarter is 35%. And remember, the fourth quarter they put in was a 7 year property, right? Be 3.5%. So let's go back and take a look. That last item should be 3.5%. Yep, ooh, there we go. Make it smaller. See this three? There you go. 3.5%. Look at the difference. Here you got we got $545, and in the prior one, right? Well, the prior one they don't calculate the actual amount, but anyway, there you go. All right, next item. What about if we have real property? Real property, not land, the property. Uses mid-month convention and depreciation using straight line. So if it's residential, it's 27.5 years. Non-residential, before 1993, you use 39 years. And then after, after May 1993, you use 39. Before, you use 31.5. Notice mid-month convention. Okay, again, a little different. Okay, another chart. So let's see. On July 12th, Scrap Happy purchased and got a warehouse. 120 is allocated to the building, 50,000 to the land. They paid 170,000. What is the amount of depreciation in the first year? Well, what you do, you take the 120,000, the value of the building, and then multiply it by 1.177%. You get $1,400. Okay, and you'd have to look. This is on the property under 7th month. So if you looked on that chart, and I don't think they have that chart here, but the chart would be in your book. You look at the 7th month, right? And on the 7th month, it would give this factor. Okay, and notice land is not included. So you see, this isn't terribly difficult to do. Okay. All right, folks, I'm going to stop it right here. We're getting ready to switch over to 179, and this is pretty common and pretty important. So I'll stop it right here. We'll be back with part 3 in just a minute.